Good morning and welcome to the Moneycontrol live stream. I hope you had a great weekend, a refreshing weekend, because this is going to be a chaotic week, Santo. Let's get started with how the market is shaping up this morning. If you look at the Nifty futures on the SGX, they are indicating a negative start for the market. Clearly, our markets are going to be affected by the performance of Wall Street on Friday, which took a beating after a strong US job reports. Now, Santo, on market current, the key question definitely is, and something that you have always been talking about, is has the tide again turned in the favor of bears? Now, if
my vote for that would be yes.
Yeah,
CJ.
I mean, if you look at the facts at this point of time, till Friday evening, the going argument was that US economy is going to tumble into a recession, and therefore the Fed will be forced to pause rate hikes as soon as September itself. But the US jobs data on Friday evening, that came out pretty strong. I mean, 390,000 jobs added, whereas expectation was of only about 319,000. So that clearly shows that the US economy is in a great footing, and probably a lot of people were hoping that probably the Fed will pause rate hikes in September or later this year. Well, bad luck, it seems.
Well, CJ, what's making life harder for policymakers is that the economy is giving mixed signals. You know, you would try to cool the economy by raising rates, you know, and at one level you're seeing that it continues to remain strong, and at the second level you also know that there's plenty of problems afoot there. So it's quite tricky for policymakers. But I'd be more closely watching, you know, the trend in mid and small cap stocks back home. They're struggling to sustain at higher levels, and the dropping volumes continuously indicate that retail interest slightly seems to be on the way. Now, you saw a good bounce back last week. CJ, I think that's more due to the fact that the selling pressure appears to have eased a bit. You're not really seeing any fresh kind of buying that would take the stocks to higher levels. So, CJ, my bet is that at this point you're still likely to see some more pressure on the market from these levels.
Well, Santo, but that said, you know, stock pickers will continue to do what they always do, and that is keep on finding good companies. And we have also compiled a list of 5 companies that we are looking out for. Starting off with Santo.
VRL Logistics, that's the first stock on our watch list today. CJ, so this is among one of the better managed, or I would say among the best managed ground logistics companies in the sector. You saw a lot of action. You've been seeing a lot of action in logistics stocks over the past couple of months. But probably what sets VRL Logistics apart, CJ, is that, you know, it's been able to maintain its margins even in very difficult environment. I think that is where, you know, properly credit should go to it. Secondly, the stock has been a consistent performer in the last couple of years. You know, it's not that, you know, a quick jump and then it starts to ease off. It's been steadily moving up, and I think increasingly in the logistics space, market is veering to the point that this is one space which will remain in the limelight for some time, and it makes sense to bet on the best players there. Also, there's a huge, according to Edelweiss, there's a huge shift happening which is underway from unorganized trucking to more organized trucking, which is where players like VRL Logistics come into the picture. And being better managed, I think it is a good chance to really reap the benefits of this trend. Edelweiss has a buy rating on the stock and has upgraded the price target to around $750.
Well, Santo, the interest, you know, one reason why the interest has been so high on logistic companies also because of the IPO of Delivery, right? Now, VRL Logistics definitely a good company. It is one of the, you know, the foremost companies when it comes to organized sector logistics. But I feel that there are better opportunities in the market, especially if you look at a company like Delivery. I mean, recently Credit Suisse came out with a note on the company, and I feel VRL, although, you know, from a traditional standpoint, it is a good company, but I feel that it will also face disruption from a company like Delivery, which is showing good execution capabilities, good adoption of technology, and as well as, you know, expansion of its market share. So for me, while the logistics space itself is growing, of course, because, you know, a lot of the unorganized players that were there, fleet operators that were there, they are getting pushed out of the market because costs are rising. Plus, a lot of them own old vehicles which they are not able to replace anymore since the scrappage policy was brought in. But for me, you know, if you look at it from a risk point of view, the only risk that VRL Logistics could face is that the economic activity could slow down going ahead, right? Now we are seeing policymakers take action. The RBI has already initiated rate hike. It is likely to do that again later this week. The government is also taking action against a few sectors which could hit commercial activity going ahead for a little while. Plus the monsoon season is coming, which is generally, or the first quarter, which is generally supposed to be a little seasonally weak for the economy. Apart from that, I feel that a stock is also priced to perfection. I mean, at 35 times, close to 35 times 12-month trailing earnings, the PE ratio for VRL is at a sharp premium to the overall industry average of about 23. So I feel, for me, there are better bets which can give me more upside in the logistics sector, such as delivery, than VRL Logistics.
I want to counter you on the last part though. You're willing to give infinite PE to delivery, which is yet to make profits, and you say that 35 is very high for VRL Logistics. How come?
Well, because it's a traditional company, whereas delivery will give me asymmetric returns. Like VRL can give me probably what, 15-20% CAGR in the next 5 to 6 years. Delivery, at the same time, its earnings, its sales itself are expected to grow more than 30% CAGR, right? So in terms of returns, it could probably give me double returns of VRL. So that's my argument. Anyway, one stock that is definitely going to give you good returns this year, in my opinion, is Coal India. I mean, dude, what a stock at this point of time. Is one of the best performers out there on the Nifty this year. Now, coal prices have remained quite firm in May, despite all the government action, to bring down energy costs and whatnot. Coal, it seems, has probably shrugged off or maybe escaped the action, the beating that overall intermediate goods have taken. In May, coal prices remained quite high compared to April. On a month-on-month basis, there has been gain. If you look at it from September levels, coal prices are now almost at double the level that they were in September. So that goes to suggest that not only, the Q1 earnings for the company are going to be quite robust and may even better the Q4 performance, which in itself was amazing for a company like Coal India, which has generally never been associated with great blockbuster earnings, Santo. So for me, in 2022, Coal India is the place I want to be, and it's the place I'm going to stick with at this point of time, even though, other commodities like, steel and, aluminium are seeing some bit of profit booking at this point of time.
CJ, what I can't quite figure out is that this has been a blowout year for coal. The numbers should have been much, much better. And yes, the numbers have been, but then why is the market not appreciating it? I mean, look at the price trends. I'm going more by technical factors here. Around October, the stock, rose to 200 rupees and then started coming off. Again in March, when it was almost a given that, prices, all commodity prices are likely to shoot up, it again went to 200, started coming off. Now it started inching back again. So despite the market being aware that this is a good company, the earnings are going to be better, and May's number were quite good, even the operating performance was good, realizations went up quite sharply even in e-auction. Coal India is able to evacuate more coal. So there are plenty of positives, and that's what beats me, So this looks like a stock where you need to play the momentum in the short term. It's a good dividend yield play. But if you see the longer term concerns, which is very clearly the ESG factor, the stock may not have a long runway ahead. Also, whenever the overall market environment improves, immediately investors start giving a cold shoulder to all the PSU stocks. That tag once again comes into play. So given all these factors, I would be I would say cautious on Coal India. Yes, the fundamentals are in favor of the company at this point, but it will probably need to be played as a trading bet more than an investment.
Well, Santo, I will take your skepticism as a sign that I probably need to be more bullish. I mean, true that 200 level has been a major resistance for the company, largely because you have investors who have not made money in Coal India for a very, very long time, who probably bought it at much lower levels. So a lot of these institutional investors or HNIs have been utilizing every rally in the stock to get out, probably because of ESG concerns, as you say, or maybe they're just so tired of holding on to the stock that they want to probably capitalize on this opportunity to get out of it. But overall, in the longer term, if you look at some of the analyst estimates for price target, they are much above the 200 resistance that the company is quoting at this point of time. And if the earnings performance continues, right, if Coal India can show that they can do this on a sequential basis, I feel a lot of longer term or at least 1 to 2 year time frame investors will also start digging into Coal India, and that could probably be the trigger for the stock to go higher. So your skepticism will actually make me more bullish at this point of time.
Well, APL Apollo Tubes, the third stock on our watch list. Now, good consistent earnings growth over the last few quarters, and this is a company which is into the value-added steel products. Again, the company has been able to maintain its operating margins. And if you see, there is a general negativity about the steel space in general. The stock too took a beating, but has recovered most of the managed to trim most of its losses over the last couple of weeks. So, this is a play on the growing demand for structured steel products in the country, and that gives me reason to be positive on the stock.
Well, Santo, the only concern I will have for APL has been a great stock. I mean, since the time it has got listed, it has made humongous returns for its investors. And overall also, given the value, the space it is in, it largely seems like it's going to be a good longer term story. But in the near term, for me, the main concern will be the margins, right? The fluctuation that we are seeing in steel prices at this point of time is just not healthy for the company's margin. And I feel while top line may actually probably be a little decent going ahead, although there are also doubts about that, given that construction activity might slow down in the coming quarters, given where construction costs stand and the monsoon rains. I feel that overall the margin is that will be a key concern, and given the the laser sharp focus that investors have at this point of time on profitability of companies, if margins tend to deteriorate going forward as well, then that will also continue to weigh on stock performance, and therefore I will probably give APL a miss at this point of time. But one stock that is definitely not worth a miss, although it has seen a bit of a correction recently, is ONGC. Now, stock is likely to get a good bump up today as well, given that Brent crude oil futures rose quite sharply in Friday's trade. Overall, there was skepticism earlier in the year that prices of oil will not sustain above $100 per barrel. You had brokerages like Citigroup in the US suggesting that it is very natural that crude oil prices could come towards $70, $75 per barrel towards the end of the year or towards the second half of the year. But even Citi recently has come out and said that they now expect crude oil prices to stay above $100. And I feel that there is increasing signs that this is going to sustain at least for the next 12 months. And so therefore, the earnings boost that ONGC gets, that will also probably sustain. Now remember, according to a lot of analysts, the current stock price of the company only factors in average realization of about $70 to $75 per barrel. At this point of time, current market price of Brent oil is about 120, 121. So there is a huge runway and a huge gap that the market has to catch up to, and therefore I feel this is another stock within the commodity space that is definitely going to do well in 2020.
CJ, my argument against ONGC is the same that I had for Coal India as well. Blowout year for oil companies in general.
Yeah.
Still, you're not seeing that excitement in the ONGC stock price, and it's still quoting below its book value. Why is the question, right?
Santo, two factors here. I think one question is therefore, of course, there is doubts about ONGC. See, unlike other oil producers out there in the world who can probably raise production to capture the benefits from higher prices, ONGC in its own self has never been great at raising its production capacity. Even when the environment has been good for it, the only doubt for ONGC has been its production has been quite inefficient, or its production capacity has been quite inefficient. Although that said, the company recently has started spending a little bit more on bringing in new oil to the market. So there is possibility for upside or surprise on that front from the company. The second factor is, of course, what the government will do, right? This is a PSU at the end of the day. We have seen what has happened with OMCs in the national interest. They have been taking huge losses on their retail fuel prices. Similarly, for ONGC, the risk remains that probably it might be forced to sell oil to PSUs at much lower prices than what the private market would probably do. So that is where I think there is a little skepticism or maybe lack of buying power from institutional investors at this point of time. But overall, even if you discount for that, I feel there is enough upside on the earnings for the stock price to be much higher from the levels that it is currently. And given that there has been 2 corrections now in the past 4 months in the stock, I feel it is also providing good opportunity or entry points for investors to get in.
The second reason is what I'm more worried about. There's not enough transparency on how ONGC makes its money. If crude oil prices go beyond a point, it's unlikely that ONGC gets to keep all the profits. Like you said, we've seen that in the case of oil marketers also, So this is again a stock I would rather give a miss. This has been an underperformer for a long time. Well, the market has opened, the Nifty is down about 46 points.
It's not bad actually. I mean, it was looking pretty ugly earlier in the morning, Santo, but we are down about 0.1%. In fact, it looks like Nifty could turn in the green, but not yet, not at this point of
CJ,
time.
don't forget Friday what happened. You had a very, very good, exciting start, and then by the end of the day, it all came off.
So well, I'm not forgetting the exciting starts and the disappointing ends, Santo. We have been through all of that for quite a long time in the past 3 to 4 months. But if you look at the advances decline, they are slightly steady at this point of time. Almost 1,050 stocks on the NSE are advancing, whereas about 825 stocks on the NSE are declining. So it's still tilted towards the favor.
We are just in the first couple of minutes of trade, CJ. So I would say hold your horses. So last stock that is on our watch list is Iron Exchange. Now, company is into water treatment and also environment solutions. Again, consistent performer over the last almost 5 years now. We have seen a steady increase in its operating profits as well as PAT. PAT has grown by about 47% compounded over the last 3 years. The company has managed to keep its debt under control as well. Institutional interest in the stock is also steadily rising. Institutions owned close to just about 5%. 2 years back, that number 3 years back, that number has now risen to about little over 12%. So that's a story which is finding takers. The only thing about Iron Exchange, one of the negative points, if you could say that, is that the company has not really been communicating. Very little is known about the company, which is why you don't see so many analysts also come out with reports on the stock. But if you were to look at purely the operating performance, the company has been doing really well, and it's clearly seen in the stock price over the last.
Well, Santo, the numbers are definitely quite impressive. But my only concern here is that I was just going through their FY21, FY22 performance, and I noticed that the share of other income, or the composition of other income in the profit after tax of the company has almost doubled from FY21 to FY22. In FY21, other income composed about 15% of the net profit, whereas in FY22 it composed about 30% of the net profit. So I'm not so sure how much of that earning bump is coming from core activities and how much of it is coming from non-core activities. That is the first part. The second part here is that if you look at, the numbers seem quite impressive, but the company itself has been trailing the industry on a few fronts, especially on the sales and the operating margin front. So that would be for me a concern, given that it seems that investors have factored in a fast growth, high profitability environment for Iron Exchange, but at the same time the earnings have been trailing the industry average. So that for me would be a little bit of a dampener on what seems like a decent story out there.
Well, 9% to 14%, the operating margin has in fact improved, and there is room. And just keep in mind one thing, CJ, in FY21, where most companies saw a sharp drop in its revenues because of the huge, of the lockdown for many months on end. This was a company which saw a very, very small decline in it, mainly because of the nature of its business that it operates in.
Santo, a small decline or a big decline is a decline at the end of the day. And I feel, maybe this is, the space that it is in the recyclability of water, it is going to be a very important space over the coming years, given where we are in terms of water crisis and how we need to better utilize the wastewater that we have currently across the globe. But at this point of time, it just seems that I would want to wait and watch and see how the company's order book develops. Remember, a lot of its order book is dependent on the government. So whether government also comes out with more orders going ahead, there is higher tendering going ahead, that will probably be a determinant on the future performance of Iron Exchange. And I would want to wait and see how that order book develops, especially, and of course, secondly, if the company communicates a little bit more so that investors and analysts can also gain a little bit more insight on the company and how it's going to perform going ahead.
Well, with that, it's a wrap on this edition of Market with Santo and CJ. Thank you for watching, and do let us know about your feedback about the show. Post it in the comment section below.
And do follow us on the social media links at the bottom of your screen, and stay tuned to moneycontrol.com and the Moneycontrol app for rest of your financial news. We'll catch you live again at 3 p.m. with all the day's action. So have a great trading session. Hopefully we'll be in the green by the time we meet again. Thank you.